Welcome to Buy, Hold, Sell. I'm Jeremy Hook from TMS Capital. Joining me today is Daniel Moore from Investors Mutual and Hamish Chalmers from Watermark Funds. What we're going to talk about today is whether there is and how it might impact about a credit crunch. Housing prices have slowed. There are lending standards which have been tightened. People are worried that this is going to be the beginning of something more entrenched. How's it going to impact? And let's get to our panellists to see. We'll start with you, Daniel. Is there a real impact already, and where is it being felt?
Yeah, no, we're definitely seeing that the banks change their lending standards, particularly around loan to income ratios, which has been pulled back quite a bit. They're now sort of having a max of about 6 times income, which is a reduction in the past, and that's having an impact on loan approvals and clearance rates in the market.
Hamish, self-managed super funds have been pulled back from some of their lendings. Westpac initially, some of the other banks. Is this another part of that puzzle, and is it getting worse?
We actually are more focused on investor lending. The investors in Sydney and Melbourne were taking anywhere between 50 and 60% of total mortgage flow at the peak about a year ago, which by international standards is just a witheringly high number. There's no international precedent for numbers anywhere near that high. So it's true that the banks are pulling back from lending to self-managed super funds for real estate. At Watermark, we're much more focused on the impact of investors pulling back. The work that we've done suggests that borrowing capacity of investors is down anywhere between 10 and 20%. And we think it's going to keep going because we know from channel checks with mortgage brokers that not all of the banks have rolled out their new loan serviceability requirements. They will do throughout the rest of the year. So the tightening should continue to go on in our view.
So a negative for the economy, or is there something positive we can say about it?
No, not really. I guess long term it rebalances the economy, and millennials can afford a house. If you're a millennial, that's probably a positive. So lower house prices impacts the economy in a bunch of different ways. Directly, it's through something called residential investment. Now, residential investment is building of new houses, renovating existing houses, and dwelling transfers. And there's a lot of literature that says when that peaks as a contribution to GDP, as it has done in Australia about 12 months ago, that's a very good leading indicator for an economic slowdown and usually a recession. Okay. So there's not a lot of good news about the housing market and residential investment rolling over.
Okay, Daniel, I mean, housing affordability getting better certainly helps and makes the economic story a bit more sustainable. Is that a positive, or is there absolutely none, as Hamish is suggesting?
I think the one positive you can say is the Royal Commission. It's good it's happened before the crisis rather than after. Yeah. Improving lending standards is a good thing, but there's no doubt the short-term impacts are negative. There's a very close correlation between house prices and household gearing levels. So as banks are less willing to lend, consequently you would expect house prices to fall.
Okay. If we were looking at the ASX listed stocks, who's going to be most affected by this, and what should we be aware of there?
Yeah, so if you look at probably the lead-in, so the companies that are right at the pointy end, so the companies that are leveraged to house prices or new housing, we sort of look at the property developers, we look at the building material companies, and probably the retail sectors which sell household goods, particularly the more expensive household goods.
Okay, so into that discretionary side now, Hamish. What are the areas that are really flashing red lights for you?
I wouldn't disagree with anything that was said before. Most of the work that we've done that informs our view on Australian housing and its impact on the economy was based on what happened in the Netherlands and the UK earlier in the decade. And exactly as described, the mortgage banks actually do reasonably well. It's the rest of the economy that disintegrates. So retailers go bust, commercial real estate collapses, people stop going to the movies, people stop going to restaurants, but they pay their mortgages. So we're focused on many of the same areas.
It's a bit gloomy there, but so what would you do? I mean, portfolio-wise, is this things you'd sell if this theme's going to take hold?
Again, what you would sell is reasonably obvious. I think the one area that might be a little bit counter-consensual is owning the housing banks. So again, when we looked overseas, if in the Dutch downturn, house prices fell about 20%. The banks lost 4 basis points on their mortgage portfolios, which is not a lot. That same number in the UK was 6 basis points, which is not a lot. And in Sweden, it was about a basis point. And so I guess to answer your question in an interesting way, a counter-consensual view that we have is that the housing banks actually will do reasonably well in this scenario. And then the businesses that will do badly are the ones that were described before.
Okay. Daniel, you mentioned some of the housing stocks, building materials. Any of those particularly a sell for you at the moment?
Yeah, I think if we think of the building materials companies, the one that's most exposed to residential housing in Australia is CSR. Mm-hmm. So despite the multiple looking quite reasonable, we think those earnings are at the top of the cycle. In terms of retail, probably the stock that's right at the pointy end, which has had a really good run in terms of earnings growth, is Nick Scali, being a furniture retailer. They're probably 2 stocks we think are right at the pointy end.
Yep, so they've had a good run, and now it's time that things are changing. Not all investments are as safe as houses.